Good afternoon, good morning, whenever you might be watching this podcast. Welcome to everyone. This is the March 2024 MSMF Wealth Management Podcast. I'm joined as usual by Mr. Cody Redding. Cody,
hello.
welcome.
Thank you.
Mr. Jay Peters. Jay, welcome.
What's up?
We are going to talk today about tax strategies. Now, before I go any further, let me give our disclaimer for my friends in compliance. We are not CPAs. We do not prepare tax returns. However, we are all three certified financial planners, and a very large part of our curriculum, you guys recall, and the test, was in taxation and tax strategies. And we spent a lot of time with our clients talking about tax strategies. So it is that time of year, so we thought we would hit that topic and would urge all of you to talk to your tax professional, your CPA, your enrolled agent, your preparer about anything that we cover today, how that applies to your situation. So we were joking before we started, what are the best possible tax strategies? And you just said, just buy Bitcoin. We're joking. We're joking. I said the easiest thing is just don't report your income. That's the easiest thing. And I'm joking too. Okay? So let's jump into this. There are still some things, guys, we have time to do before we file our tax returns for 2023. And actually, if we file an extension, some of these things apply there as well. So, Cody, let me start with you. For the 2023 tax year, we're in the reporting season now for that. What can our clients, friends of our family of our clients, what can they do as it relates to retirement plans still?
Yeah, for retirement plans, if you're, usually people that are self-employed or sole proprietors, you can still make and even for corporations, you can still make the employer contribution up to the tax filing deadline plus the extensions. Mm-hmm. And if you're sole proprietor, well, you even got a little bit more flexibility that your employee and employer contributions, depending on how your company is taxed. For example, like Schedule C gives you the most flexibility to where you have until the tax filing deadline plus the extensions to make those contributions. So that's retirement plan space. It can get a little complex on that, but there's the taxation on it, or being able to file the extensions and playing that game right can give you a lot more time, 6 more months, really.
Sure, absolutely. And again, nothing can be done from an employee's perspective for their 401k, but they may well be able to make a tax-advantaged IRA contribution, right? Correct.
So if a lot of W-2 people, that April 15th deadline for your IRA or Roth IRA contribution, you don't get the extension on that. Right. So even if you file an extension, you still need to make that contribution by the 15th.
Gotcha. Perfect. Jay, one of my favorite topics, which I lovingly call HSA's unicorns. Maybe you could explain that and tell us what our clients and friends of our family of our clients can still do with HSAs for 2023.
Right on. Yeah. So, excuse me. So HSA, a quick reminder, that's if you have a high deductible health plan, then oftentimes you can have access to an HSA or health spending account or health savings account, sorry. And with those, what's kind of nice is even though the year has rolled over, a lot of times you can still make a contribution to that account all the way until tax filing deadline. The advantages there, tax-wise, are you get an income tax deduction for that year, right? So you can still make it for 23.
Yep.
It grows tax deferred, which is great. And as long as you use it for medical expenses, which who doesn't have those, that it's going to be tax-free as well. So triple tax advantaged unicorn. Love it. Definitely max that out if you have the capability to do so.
Right. Then at my age, more and more medical expenses. So highly useful.
Kids. I mean,
yeah, certainly. So not a lot for 2023, but there still are some legit strategies that our clients can engage in to manage that tax bill from last year. But let's really focus on looking forward. Strategies for 2024 and really beyond. And I want to talk both here at the beginning and at the end about some legislative issues. But let's start with where we are today, Cody, legislatively, and kind of where you see the laws as we know it, and how that's going to change itself over the next couple of years.
Yeah, so, as of today, we know for at least the next 2 years, most likely what the tax rates are going to be. So being able to take advantage of the higher standard deduction, especially in low income years, and there's all sorts of stuff we'll get to later with Roth conversions and things like that. But we know for 24 and 25, kind of what's on the table, and utilizing that as most as possible.
Right. And Jay, I know President Biden has kind of raised some smoke signals about tax rates should he get reelected. Cody says we know what they are, but where do we stand there? Could things change where we know what the rules are? We know there's a sunset coming, but could things change in the next couple of years?
Yeah, they always could be, but I feel like it's going to be a little more difficult to make any changes until there is a new administration in Congress and all that. So that's why we're, like Cody said, we know what they are now, and we don't think there's going to be any changes, so we can really get proactive on some of these strategies for the next 2 years.
Gotcha. Thank you. Cody, back to you. You know, some of my head's kind of on a swivel here. You mentioned Roth conversions. Talk to our clients relative to that strategy looking forward, and I think that relates back to the known tax rates for the next couple of years and what you're telling your clients.
Yeah, so for a lot of people that are in low income earning years right now, probably people that have retired and maybe not having to dip into their IRA assets, it's a good time to look at doing some conversions. You have a high standard deduction, in that 10 and 12% federal bracket up to a pretty good amount of income. You can really take advantage of converting that because thinking most likely in the future that tax rates would probably go up given the current debt situation the U.S. has.
Gotcha. Excellent. Back over here. So Jay, let's go back to my friend the unicorn, and Mama Unicorn has a baby. Maybe you can talk about HSAs and FSAs. Yeah,
perfect. So already kind of talked about the benefits of HSA. Again, you have to have a high deductible plan for that one, so keep that in mind. You can also have access a lot of times to an FSA. So maybe if you don't have a high deductible plan, maybe you can do a flexible spending account. Where with that one, it's a use it or lose it. So you still get a pretty good benefit for using it, but you have a deadline to get that money out. So that might be a good time to sign up for that and make sure you're taking advantage of that. And then related to that one, a lot of times overlooked, you mentioned if there are baby unicorns, would be the child care FSA. Now that one's kind of unique because you can do that with an HSA and with another FSA. But with that, you get to do up to $5,000 where you kind of get to remove it from your income if you're going to use it towards child care. And it's specific of what type of child care. Like you can't do it for anything. It can't be different school programs. But as long as you use it towards daycare that you're probably already going to spend it on anyway, you might as well go through that child care FSA and get the tax savings for it.
Super. HSA, you may mention this, I didn't catch it. Is it unlimited or is there a cap on it? What's the HSA limit?
Every year they change it, and it depends on if it's family or individual. I believe the family number, I'm making this up, is around $7,500 for last year, and for this year, I'm assuming it went up a couple $100. Okay. So I think it's less than 8, but more than 75.
The peanut gallery, Craig says it's
$7,750.
$7,750. We're getting pretty precise.
$7,750. So I was right in the middle.
Excellent. No, great strategies. Love those. I know you guys talk to your clients about those all the time. Cody, something that we do more towards the end of the year, but I think it's important for us to prepare our clients for it, is tax loss harvesting. Maybe you could explain that, explain what we're looking for with the accounts that we manage for our clients and what benefit it can be.
Yeah, for tax loss harvesting, near the end of the year, because we kind of know what the income and all that and realized gains maybe in the portfolios, well, you can offset some of those gains or carry forward some of those losses that you have to the next year's tax return by kind of singling out those funds and selling them at a loss, because we know what the tax code is today, that you can actually take the loss. And there's been some rumors going in the future, maybe that would go away if you're over a certain income limit, and that could muddy the water. So taking advantage of that now is probably a good thing to do.
Yeah, and we look at that automatically, right?
Yeah.
And if clients have accounts that aren't with us, just a recommendation that they kind of talk to their advisor, or if they're doing an online account, just to kind of take a look at the the gain and loss for a particular year, or ongoing, I should say, to see where that's at.
Yep, and knowing the rules on when to buy back too.
That's a big one. Yeah,
That's
there's we won't get into that, but there's some very specific rules in terms of when you do tax loss harvesting, and you want to buy that position back when you can buy it. So just call us. We're happy to talk to you about it.
Right.
Jay, we spend a lot of times with clients on RMDs, or required minimum distributions, which is when a client gets to be of a certain age, they have to start pulling money out of their IRA and or 401k. There's been a lot of changes recently. So we have some newbie RMDers this year. Maybe you could talk to our clients about that and what strategies are out there for that.
Yeah, so there's, excuse me, there's two categories of newbies that I wanted to kind of talk to. One would be if you have a new inherited IRA that you didn't have before, guess what? You need to start taking some money out of that, right? But then the other one that there's a unique group of people that you weren't 70 and a half, the original date, before they changed it, and then they changed it to 72, and then they changed it to 73, and so that they keep raising it.
Right.
Well, they stopped raising it for some of you, and so just to make it simple, basically, if you were born before 1960, then it's when you were 70, the year you turned 73, and if it's 1960 or later, it's when you turn 75. So there's a group of people that are you just now turned 73 this year. You're going to have to take an RMD. So heads up.
Okay, and what are their strategies? Because that means, again, we're taking money out of a 401k or an IRA. In all likelihood, none of it's ever been taxed, so it's going to be taxable income on somebody's tax return. Many of our clients say, "My gosh, I don't need the money. What should I do with it?" There's one very focused strategy. Maybe you could explain that, another acronym that we use that could work for clients.
Yes, and with that, you're alluding to the QCD, or
QCD.
Qualified Charitable
Deduction.
Deduction. Dang it. And with that one, the important part is, and ironically, you don't need to be RMD age to do this one. This one's still 70 and a half.
70 and a half.
Another one of those weird things in the tax code. But with that, if you don't need the income, you don't need the money, especially if you already are planning to give it to a charity anyway, you can just directly send it to the charity, bypass it showing up on your tax return, support your favorite charity, and satisfy your RMD at the same time. It's a win-win for everybody.
Super. And you just explained why we're in business. Because QCDs have one age and RMDs have another age now, which they've been changing. So they used to be aligned, and now they're separate. Give us a call if you'd like to investigate some of that. It's 70 and a half for the qualified charitable deduction. It's now 73 for the required minimum distribution. We can marry those up. Great strategy. I know you work with it a lot with your clients. Cody, let's go back to retirement plan contributions, because now we're kind of looking forward, trying to come to some strategies for this year and beyond. We know new tax rates are likely coming in a couple years. What are your thoughts there, and what are you coaching your clients on?
Yeah, I think going back to the Roth, if you're in that 10 or 12% federal bracket and you got a little bit more time to retirement, what's the best bang for your buck? For, if you have the Roth option available, utilizing that, certainly talking to your advisor to see which kind of makes the most sense for you. Like me, I split the difference and I put some in my pre-tax and some in my Roth. And also, this is a good time of year when the New Year's come around, and the 1% challenge that we had to say for your retirement plan is if whatever you're putting in, raise that by 1%. You don't really feel it too much, and it's a good way to get you up to a higher threshold of what you're putting into the plan.
Super. Yeah, and I know, because Craig and I just had a meeting last week with a client. A lot of clients don't know they have a Roth option on their 401k.
Yeah, a lot of plans do.
Right, because it's a recent invention, if you will, and they may have added it to the plan, and you missed the memo, you missed the email, the announcement. It's worth looking to see if you have that Roth option, because, as we always like to joke, in 50,000 plus pages of U.S. tax code, the word tax and free show up next to each other like once or twice. So it's certainly worth looking at, right?
Yes.
What about new for 2024 as well? So with Secure Act 2.0, another thing that's new for 2024 is some employers have the option now that if they're doing like a match, that can also be, you can choose that to be Roth as well.
Right.
Now, not all plans have figured out how to do that or are even capable of doing it, but that's another opportunity to put some Roth savings in there. So check with your plan. You never know.
Yeah, it might be some changes coming or notices that you get, and that's what probably a lot of them will be about the Roth for the employer.
Yeah, and I would say a lot of the spaghetti behind the scenes that manages these plans probably hasn't been sorted out
Right.
to do that yet. But to Cody's point and your point, it's coming, and it's attractive because right now, or as of end of last year, the only place they could put matching was in the traditional deferral piece of a 401k. So, all right, Jay, we're moving at a breakneck pace, which we are. We may have to put the outline in the podcast just so people can see. Okay, I should have written that down. Talk to me about gifting strategies because it's again, with this higher tax rates looming over the top of our head, this is a big issue.
Yeah, and so I'm thinking about like who would use this the most. It's probably someone who is already retired and they're trying to figure out how can I start passing some of this down to my heirs without paying the taxes on it or having them pay the taxes on it, right? So, and that's not the only case, but that's probably who I'm talking to right now. Mm-hmm. So every year you can give up to a certain amount to anybody you want and not have to worry about any gift taxes or gift tax return, right? And so that for this year is $18,000. So that's number one way to think about if you're trying to move assets to somebody else, right? And there's some other tricks around that too, but for now we'll keep it simple right there, right? And then the second way is, again, if you've had like a really good income year, and you're looking at how can I save more on that, and I know I'm going to be giving some to a charity at some point in the future, then you can look into what we call a donor advised fund. So with that, you can put a sizable amount into there, lower your taxes that due for this year, and still kind of have some control over it, and then give it out to the different charities, but at least one charity over time. Yeah. So another way to really take advantage this year of where we're at.
Super. Makes me think it would be a great podcast to just do gifting strategies at some point because there are quite a few.
Yeah.
So, and that leads into particularly, again, with the change in tax rates looming in a couple years, as legislation currently stands, some estate planning considerations, right? Because not only are income tax rates going to change, the unified credit is going to be basically cut in half, which is a big deal as of January 1st, 2026, barring any other change. So that is something we're recommending clients go back, pull out their estate planning documents, their trusts, their wills, powers of attorney. Let's look at that. Let's get you all dressed up, ready to go see your attorney because there may be some strategies that we have to address relative to that. And I like the gifting strategies because we encourage our clients all the time. Enjoy it while you're alive. Enjoy seeing your kids, your grandkids, your favorite charities benefit from, your charitable intent and how you want to help people. See it while you're alive so you can see people enjoy that. Okay? All right, well, let's close this out. I'm going to ask you guys to look into the crystal ball on this table. Imagine it there. And Cody, I'll start with you. Talk to me about possibilities of where we see this tax code and really how tax strategies we may have to double down on those going forward.
Yeah, I mean, just kind of looking into the future, if nothing happens, we know for the sunset, we know that it goes back to the taxes that Obama put in place. So that means rates are going to go up for a majority of people that are listening to this. But, kind of looking even a little bit more out into the future is like, heck, as the U.S., we have a lot of debt, 34 to 35 trillion, I think, right now. And there's really no way to start tackling that without probably tax rates going up for the majority of people listening on this call.
Right.
And not to the fact that probably some government spending is going to have to be cut. So I think they're going to have to do kind of both. So we, really historically kind of low tax rates right now. So using that to our advantage, we talked about the Roth conversions, talked about the gifting. That's a big one because that's going to get cut in half as of really kind of today. And so I think certainly if you haven't, talking to your advisor and getting a strategy put in place, and maybe that's something you could utilize. Yeah, you might have to pay some taxes today, but if you try to do this in the future, you might have to pay a lot more taxes on it, that kind of thing.
Super. Yeah. Jay, thoughts?
Yeah, another angle, everything, Cody, you said I 100% agree with. And then another thing is like capital gains rates and all these different things that every time they float something new across, it's like, man, that's going to affect so many of our clients in
Right.
these different areas. So just knowing that, taxes are probably the lowest they're going to be for a while. And so a lot of times when we're sitting with our clients, to say what you said a different way, a lot of times it's about paying the least amount of tax over your lifetime or your heirs' lifetime, not necessarily this year.
Right.
And so sometimes it's volunteering to pay a known tax rate because we think it's probably going to be higher in the future. So, yeah.
Excellent. Excellent. Least amount of taxes legally.
True.
I don't look good in pretty silver bracelets that are connected, right? It's not good for me. So, I think you guys said it best. We know what we know for the next couple of years. So there's definitive short-term strategies, and then there's planning for the possibilities long-term, right? So I highly encourage any of you, if you have any questions on what we talked about relative to tax strategies now or into the future, give us a buzz. Shoot us an email, use our text line. Happy to sit down and talk to you relative to kind of what you're facing, what your questions are. Feel free to share this with your friends, family, colleagues. We're happy to answer their questions without any expectations as well. So thanks for listening in, and we look forward to talking to you guys next month.